Good morning. Happy Friday morning from the Asia Pacific. Just half an hour to the open. Hong Kong, Shanghai, and Shenzhen. You're watching The China Show. I'm David Ingles. Let's get to your top stories today. NASDAQ futures under pressure on a reports that Nvidia is asking component suppliers to halt work on its H20 AI chip. That's after China urged local companies not to use it. Now, caution dominates trade across the Asia Pacific as signs of U.S. economic strength have traders trimming their bets on Fed rate cuts. That comes ahead, of course, of Jackson Hole and Jay Powell's speech there. And Boeing is said to be close to finalizing a deal with China for as many as 500 aircraft, ending a multi-year sales drought. Good morning again. Welcome to the program. Hope you're all well. That's the time to the opening bell today. Caution is dominating a couple of things, right? So the last few minutes or so, NASDAQ futures, as you can see, are now flat. Certainly a story out of the information here that Nvidia has ordered the suspension of production of its H20 chips. That's point number one. Point number two is we're headed into Jackson Hole. There's really no major catalyst to add more risk. In fact, the S&P 500 is down for 5 straight days going into the session today. We're up 1% as far as tech goes, Kospi and the TAIEX index, more on that certainly in a moment. Apart from those three things, liquidity rally continues to be the story, of course, when we look at these Chinese markets with 3,800 now in sights on the Shanghai Composite. More on that in a moment too. Right. Also, inflation came out of Japan earlier on at about in line with estimates, with the exception of core CPI, which came in slightly above the median, but it's still a pullback, though, from the previous reading as far as that's concerned. 2 and 10-year yields, of course, the commentary coming out of the Fed, and we'll have, again, more on that later on. We're now looking at the lowest probability as far as Fed fund futures, even if you go by swaps, of a Fed cuts next month. So there has been an adjustment in positioning ahead of Jackson Hole and certainly following the data that we had overnight with U.S. manufacturing, 2022 highs as far as that's concerned. Right, a couple of big names to track going into the open today. Not an exhaustive list, of course. You have XPeng, massive move up. You have the CEO increasing his holdings, point number one. Of course, EVs rallying on the back of that. We have an index review, and results are out after the close later today. So we'll watch out for the likes of potential, and the speculated names include the likes of PopMart, for example. Declines across the solar names, so certainly that was one cohort we'll be tracking going into the open today, including, of course, tech. Right, very quickly, let's have a look at where we are. A50 futures doing this. We are down a third day on the Hang Seng Tech Index, and we talked about 3,800 there on the Shanghai Composite. Morgan Stanley will be joining us on shows later this hour, and they do think that this liquidity-driven rally can continue through the summer months. Okay, let's get to the breaking news. In the last few minutes or so, Nvidia ordering a suspension of its H20 chip production. That's according to the information. Stephen Engel, our Chief North Asia correspondent, is here with us to talk us through what we know so far based on this specific report, Steve.
Yeah, from the information is where we're getting this source story, essentially saying that Nvidia has instructed its parts suppliers, we're talking like Samsung, which provides the high bandwidth memory component to the H20 AI chip, as well as Amkor Technology. It does the advanced packaging for the H20. And essentially now those inventories at those companies are starting to pile up because, again, the Chinese government, what we've been hearing over recent weeks, multiple regulatory agencies, whether it's the Cyberspace Administration of China, the CAC, the National Development Reform Commission, the top planning body in China, and also the Industry of Information Technology, the MIIT, have all started to instruct Chinese companies to stop buying the H20. And the H20 is quite a saga in itself. Of course, it was essentially banned by the Trump administration in April, selling into China. They needed to get advanced export licenses to sell to China. There was that reversal, high-profile reversal last month when Jensen Huang traveled to D.C., met with Trump, and then he traveled on to Beijing, simultaneously announcing that that ban had been removed. Nvidia could sell the H20, the watered-down version of its most advanced AI chips, back into China. But also there was some controversy there, too, because AMD and Nvidia both kind of had to agree to pay 15% of their collective revenue from those chips sold into China to the U.S. government. That's a whole different story. Right now, the story is the turnaround that Nvidia saw that they could resell into China seems to have ground to a bit of a halt because of the Chinese efforts to not buy the H20 and start relying more on their own domestic components. Because again, not only the comments from Howard Lutnick to CNBC on July 15th, which was insulting according to sources to the Chinese, when he said, we're not selling them our best things, our best chips, we're not even selling them our second best chips. We're not even selling them our third best product. So that was insulting to the Chinese. The Chinese also kind of concerned about any potential backdoors in those chips to send essentially nefariously the Chinese data back to the United States government. So there's a lot of geopolitics, but definitely this is a big issue for Nvidia.
And it's an added plot twist to watch. I think Nvidia reports, next week in about 5 or 6 days.
On Thursday, yeah.
On Thursday next week. So what are we watching then? How does this dovetail into the broader conversations around that stock, which has really hit highs?
Well, despite the technology, the mega cap tech sell-off of the last few days, which Nvidia has been a part of as well, down the last 3 days. But, 9 key analysts have raised their price targets more recently on Nvidia with higher price targets. And a lot of that is to do with the resumption of China. This was CJ Muse, among other analysts at Cantor Fitzgerald, said China is already de-risked in street modeling, and the goal here is to get China to build on Nvidia's platform. That was from an August 18th note. A lot has changed now with this developing story right now, coming from those reports from the information, but also the FT had a story yesterday outlining more of the details of the Chinese resistance to resume purchases of this H20. Keep in mind, simultaneously, while Nvidia had seen the H20 banned back in April, they were developing in lockstep another chip that they would sell into China. We need to get more information, perhaps next week. You asked about the earnings and the conference call. What is the actual ramification to Nvidia right now? Where are they pivoting, or if they are pivoting, to this other chip that they were planning to sell into China, the Blackwell RTX Pro 6000 architecture, a watered-down version of that?
Steve, fantastic. Thank you so much. We'll keep an eye on this, of course. NASDAQ futures on your screens. Initial dip, and as you can see, we're right at about the zero line at this point in time. Right, so that's one top story to consider going into the open today. The other, of course, we're waking up the Asia Pacific with Fed pricing expectations lowered from, let's call it 85 to about 90%. We're down to about 75. A lot of that was down to, number one, the data that's come through, and this is the one that came through, of course, 53.3, which is the highest reading on U.S. manufacturing PMI in 3 years. The point number two here is actually it also came in way above even the highest forecast. So that really coming out of, I wouldn't say coming out of nowhere, but certainly it wasn't expected as far as the range of projections were concerned, right? So what do we do with this information? We had former and also current Fed officials, in fact, ahead of Jackson Hole, weighing in on really the chances of a rate cut in September as traders await Jay Powell's speech at Jackson Hole later Friday. Have a look.
I don't see any chance that there's a nod toward a September cut or any promise of a September cut.
The caution I would give, if they do move in September, I don't think that's the start of a cycle. I think it's an individual decision. Then they'll wipe the slate clean and take the next 6 weeks, try to understand these cross currents again.
I think they're modestly restrictive. I'm still trying to find ways what's being inhibited in the economy from where our policy rate is today. But I think we're on a good path.
For sure, it feels to me like it's a live meeting. As you know, before April 2nd, before we got some uncertainties coming on the policy side, I believed that we had pretty stable full employment, that inflation's coming down to target.
It's interesting, right? So you also have Cleveland Fed President Beth Hammack actually talking about how she would not support lowering interest rates if central bankers were, say, deciding with the information we have right now tomorrow. Let's bring in our team. Jill Deeses, our news desk editor, and on the market side of things, Paul Dobson, our Asia Markets executive editor in Singapore for us. We'll start with you, Jill. Yeah, just wrap up the comments out of the Fed.
Yeah, David, I really thought the Goolsbee comments in particular were really interesting because it really does kind of show some of this back and forth over how exactly the Fed is grappling with some of these issues around its dual mandate right now, right? I mean, one other thing that he also said in those comments was that, that recent inflation data point, that uptick in services inflation, he described it as, potentially dangerous, but that he hoped it was a bit of a blip. And, I'm taking that in context also with the recent FOMC minutes that were released from their last meeting, of course, that came before those labor data revisions. But that really kind of showing that inflation really still is really key on the minds of a lot of these Fed officials. A lot of them are weighing that over some concerns about labor market data when they're kind of putting together this calculus. And I think that ultimately tells us that maybe the September meeting really is a live one. And I think all the more reason why we're so keen to look ahead to this speech from Powell. So this is happening at 10 a.m. Eastern Friday. So that's, this evening for us out here in Asia. But I mean, any kind of hints that we're going to get from Powell on any kind of direction that the Fed may take in September, obviously incredibly welcome, for traders just kind of looking for some kind of direction. He's obviously used Jackson Hole in previous years to give hints on what the Fed's policy trajectory may be. Will we see that this time around? Not sure. But again, I think, some of the sort of uncertainty around this data really does point to this idea of, do we really have that clarity over whether the Fed is going to resume cutting in September? I'm not sure we do.
Separately, but still on the broader Fed conversation, is Lisa Cook. What's the latest there?
Yeah, I think, really sort of the Trump pressure campaign toward trying to remove Lisa Cook, obviously citing these allegations of mortgage fraud, really does kind of point to this idea that, Trump is trying to have as much influence over the Fed as possible. It does seem like what Trump, the thinking within the Trump administration and perhaps within Donald Trump himself is that he would prefer whether she resign or whether Powell actually fires her rather than Trump himself sort of stepping in and trying to oust Lisa Cook. She obviously has said that, she has no intention of resigning or anything like that. But I think just, sort of that broader, that broader issue really pointing to how this pressure campaign from the Trump administration against the Fed is really kind of escalating in some pretty dramatic ways.
All right. Paul, let me bring you in here in the markets angle, too. Certainly, we've seen markets price back a little bit these bets for a cut in September. The lack of, I guess, appetite to take on more risk going into Jackson Hole is quite evident this week, hasn't it, Paul?
Yes, that's right. So we've seen equities coming under a bit of pressure, and what added to that was the bond market coming under pressure yesterday after that very strong PMI number. So the market had pretty much convinced itself that we would see a cut in interest rates by the Fed in September. That pricing, as you were saying, David, got all the way up towards 100% fully priced, and now we're back down to 70%. We'd even seen people putting money on a sort of a extra big cut, 50 basis point cut. That now seems in doubt, particularly with that economic strength there. The trade-off, the balance for those Fed officials is, should they be more worried about the economy rolling over, the very weak jobs numbers and revisions that we saw most recently, or should they be worried about the still very elevated inflation levels? And what we've heard, I think, from the commentary so far at Jackson Hole is not a lot of signs of shift in the positions of the various Fed governors from where they were previously. Goolsbee, yes, is the one saying, yes, it's a live meeting, but I'm not seeing a lot of movement elsewhere there. And so, the tone that Powell takes is going to be all important here, but the market is starting to have, starting to doubt itself a little bit about whether the September cut is going to come through after all.
Paul, just staying on the macro here, inflation out of Japan about just under 2 hours back here, roughly in line, although you did get core coming in slightly higher than expected. The yield story there has really been one direction, and that's been on the way up. Are markets getting ahead of ourselves here?
I think that the BOJ would like to hike before the end of the year. Is probably not rushing to do that either. September, October, December, I think are the options ahead of it. Probably the middle of those is the one that seems most likely in the market's calculus. We will hear from Wader at Jackson Hole as well, so that will be interesting to pay attention to. But I don't think the market is getting ahead of itself in that sort of long-term outlook. We have the high inflation numbers. We know that the BOJ is under pressure to come and control that somewhat, with some help maybe on the fiscal side as well. We are expecting that there will be higher interest rates in time, but steady and gradual, so as not to cause too big a sell-off. I think that otherwise it's just, a very big long-term reset in the mentality of the entire economy in Japan, going from very, very steady prices to an inflationary environment. And that is causing a jolt and a little bit of disruption, a little bit of angst and concern. We have a pretty torrid political situation as a part of that as well. So the BOJ knows that it has to calibrate things very carefully and cautiously. It wants inflation. It doesn't want to blow it up, but it doesn't want too much inflation. So I think that the market is, pushing those yields up all the time. Maybe at the back end of the yield curve, more life insurers are starting to pay attention now to the opportunities of locking in those longer term interest rates. But the other thing that we've had is, stock market gains. And if they were gaining on the stock market side, they don't need to worry so much about buying more on the bond side.
There we go, Paul. Thank you so much. Paul Dobson there on the markets end of things. Jill Deese is getting us up to speed here on the specific Fed conversations taking place right now. Right, looking ahead on shows here, what do we have? Boeing edging closer to its first aircraft mega deal with China since 2017. Details of that Bloomberg scoop coming up. And of course, going into the open today, we're looking at the fix point number one, earnings coming through, earnings reaction. The opening bell 13 minutes away. This is the China Show. Good morning. Good morning. A couple of things to track going into the open today. So a specific level in the Shanghai Comp is a level I believe we haven't seen in about 10 years or so. That's 3,800. Alongside and related to that has been really turnover, which has picked up. I think it's been north of 2 trillion a day last 5 or 6 days onshore. That's overall onshore. Overheating signs, that's both in the market potentially with an RSI in the Shanghai Comp of I think it's 81. Or when you're looking at the weather, there's literally a very hot weather warning here in Hong Kong. Ahead of, I believe, some weather coming through on Sunday. HIBOR's obviously still going to be very much in focus, and also some potential changes to the index. And of course, Wang is in Pakistan. Futures are pointing lower ahead of the open, and also a lot of earnings coming through, including the likes of the big property developer Wang, Ping An Bank, CSBC Pharma, among other names set to report later today. Right, now on this Boeing scoop, so Bloomberg has learned that Boeing is close to finalizing a deal to sell a couple of hundred aircraft to China, a massive one if it goes through. The deal is of course contingent on the diffusing of trade hostilities that go back to Trump's first term in office. Min Min Lo, our China correspondent, is here with us with what we know about this. The centerpiece for any trade agreements between the U.S. and China is really a deal on airplanes.
Yeah, I mean, these planes are hundreds of millions of dollars for one plane, so it's a very, very big deal. It would go some way to reduce the trade imbalance between China and the U.S. if it comes through. And this also would put an end to this sales drought that we have seen since 2017 when Trump last visited China. That was when China and the U.S. had announced this deal at the time, $37 billion worth of deal, where China committed to order about 300 airplanes. But since 2019, we show you that chart, you can see that the number of orders of Boeing planes started to decline quite steeply, and that really dovetailed with the sort of souring relations between the two sides. And so, yes, right now we know that the Chinese government had been, checking with Chinese airlines in terms of how many aircraft that they want to get. Boeing is also, looking at finalizing the terms of the deal in terms of delivery timeline, what types of jets that China would want. But here you can see this chart, the big drop-off in that white column from 2019 onwards. But it looks like now the talks are being revived, and maybe we might get a repeat of 2017 if Trump does announce this sort of deal, when he meets with President Xi again.
Okay, Min Min, thank you so much. Min Min Lo, our China correspondent there with the Bloomberg scoop on the Boeing story, following, of course, the other one on Airbus. Also very, very recently. Right, we're just going 9 minutes to the opening bell here. We are getting pre-market indications already coming up on your screens very, very shortly. Keep in mind there's an Nvidia story that goes into potentially 981. That's SMIC. We'll see what that stock is doing in a moment here. We are on track for a weekly drop on global stocks. Obviously, the same is it's a different equation when you talk about the Chinese market, specifically onshore. And yeah, there we go. XPeng on the back of the CEO adding to his holdings. I believe 18% now, 9.3% to the upside, and PopMart still seeing some upside today, and there we go, to the point we were making SMIC up about 2.25%. Plenty more ahead. This is the China Show. Good morning. Good morning and happy Friday. We finally get to the weekend, about a session away. And of course, by the time you realize it's a weekend, it's Jackson Hole. We're going to figure out what Jay Powell's going to say in his speech. There's a BOJ, of course, and Governor, of course, is also there at Jackson Hole. And before you know it, we're blessed with Monday, right? So how quickly time actually flies. Right, a couple of things as we go into the open today. Hang Seng Index 25.2. We are getting some upside right now, and I believe actually we are getting a pull there from the EV space with the likes of Geely. We talked about XPeng actually seeing some upside right now. So Hang Seng Tech, after 3 days of declines, is seeing quite a decent pop to the upside of about 1%. Nothing much to note as far as the fix goes. Kuaishou down about 0.2 to 1%. You have a special div there. Bilibili, that's really mirroring what we had overnight in the U.S. session. And Sino Biopharma, of course, is another stock we're tracking here as well. There's still an earnings story here as well. Right, XPeng, big move overnight. You have the CEO coming in and increasing his holdings, which is, I guess, in many ways, in many forms, a good sign of confidence there in the stock itself. NEO is up about 6%. That's really getting pulled up because of the sort of the broader move up in the sector as well. SMIC 981. In case you missed it, the information was out with the story here on Nvidia asking its suppliers, maybe don't make these H20 chips. We're up 2.2%, perhaps the nearest supplement replacement to Nvidia as it pertains to the Chinese market. Right. Okay, going into the open today, I think we can we pull up 1908, please, if we can here. So we're looking at turnover today still. So we've seen north of 2 trillion daily turnover for 7 straight days now. Morgan Stanley, Laura Wang and her team have put out a note that they think this liquidity-driven rally can continue through the summer. She'll be joining us in a couple of minutes to really just lay out the thesis, what factors to watch, what risks to watch as we go into today. And just one very quick note, as we move into the final session of the week, we're looking at a Shanghai Composite here because possibly, quite possibly, we could see 3,800 for the very first time, I believe, in about 10 years or so. So the opening bell, and we'll find out all those things we just laid out in a couple of minutes. This is Bloomberg. Good morning, and in case you are not keeping track, happy Friday. There we go. 40 seconds to the opening bell. We're looking at gains here. Hang Seng Index at 25.2. We have more news coming out of Nvidia. This is this is separate, but we'll see if he comments around this report coming through. So the Nvidia, So the Nvidia CEO has now reaffirmed that the H20 AI chip has no security backers. Now, that would be more useful information, of course, if in fact they were selling it to China, but we understand from the information that Nvidia has then asked its suppliers to stop making the H20 chip. That's point number one. Point number two is he's also visiting the TSMC for the production of the Rubin chips. Okay, the opening bell is a couple of seconds away. We're looking at the onshore markets first and foremost. Are we going to get 3,800 for the first time? We're very close, not quite on the Shanghai Comp. CSI 300, just a tad below the 4,300 level. Morgan Stanley will be joining us later on in a couple of minutes here. So they think 4,700, I think, is the move on the CSI. We will unpack that call in a moment. We're doing on the 10-year yield is up. 178 now on the 10-year yield, and the 30-year yield is at just, let's call it 2.1%. So the melt up in yields is halting for now, but that said, it's really been a trend. The last 2-3 weeks has been to the upside as far as that's concerned. Okay, flip the page, please. Are we getting 600 on 10 cent? We'll find out. And 10 cent is now just a tad short of 597 right now. Bottom panel, leftmost side. We're also looking at Xiaomi's up 1.3. That's an earnings story this week. Baba is reporting. Let me rack my brain. It's 29th. There we go. Yes, this time next week. Thank you so much to my producers for whispering not sweet nothings in my ear. Dollar Hong Kong. There we go. 781.25. Hybrids on watch today. I think it halted the gains yesterday, but yeah, still we're watching it very closely as well today. 0.6% on the Hang Seng Tech Index. Flip the page. Halting. I believe 3 days of gains going into the open today. Right, the CEO of Xpeng adding to his holdings, up 10% overnight, roughly speaking, up another 10 right now in the H-share market. CSBC Pharma, I believe, is reporting today, and of course the SMIC story is getting a pop there out of the Nvidia news coming through. And finally, PopMart's not gaining today, but it's too early to say, right? It usually started out the day weak, and then it ended up 12% higher on Wednesday. Anyway, that's a story we can, I guess, table for now. We've talked a lot about PopMart's story already. Okay, where are we now on the A-share market rally? So from the respective lows in 2024, 4 benchmarks on your screens, the varying levels of good, right? China 70%. Again, they didn't bottom at the same time in 2024, so we've taken their respective low and did this. Now, as far as a snapshot of where we are here on the onshore market, right? So we've taken a couple of things. Turnover Monday to Wednesday has been this amount. It's the best performing cohort, Asia Pacific, in August. Daily turnover, there we go. Factor drivers, liquidity, momentum, and growth, by the way. FTW is a function you run on your Bloomberg terminal, by the way, if you want to understand it even further. And Morgan Stanley has this quote out, coming through on your screens very, very shortly. They do think the rally can continue. Such momentum will sustain through the summer as the government accelerates the rollout. Change the page. Page 2, please. Measures and incremental liquidities get mobilized. CSI, there we go, bull case at 4,700s. Joining us now is the author of that report, Laura Wang, Chief China Equity Strategist at Morgan Stanley. Good morning.
Good morning to you, David.
It's been not a quiet summer. It's been a good summer for the Asia market. You guys say this can continue. Lay out the thesis for us here.
Yeah, I mean, we're very happy to see how things have been going so far, because back in June, we explicitly told investors now is the time to actually move your money into the Asia market, and this summer is the time for the Asia market to outperform on an absolute and relative basis. So the thesis is like this, right? We actually see incremental step up of easing measures, as you mentioned, and also the anti-involution specifically. I think this really set the cornerstone for sentiment improvement for onshore investors. So 2 things we have noticed that's really set this cycle rally apart from the previous short-lived rallies. For example, we had a very short-lived rally in September, October last year, and if we actually rewind back to right after COVID reopening, we had a short-lived rally in early 2023. But if you look at how the market has been responding to these rallies and versus this cycle, we see 2 things different. Number one is the onshore long-term bond yields are really picking up this time. If you look at a 10-year bond yield, 30-year bond yield, both are picking up in the steady phases. Actually, those had never happened in the previous rally. So I think this shows that onshore investors this time, for the very first time in a long time, are seeing a more upbeat outlook for China macro. So that's very important, because anti-involution, I think, really helps onshore investors believe that the pricing situation onshore, the deflation situation onshore actually is likely to improve from here. Second is that liquidity is really improving. I think a lot of investors have been saying that interest rate in China has been very, very low. There's ample liquidity, but investors just don't want to go into the equity market. I can understand why people say that, but it's not necessarily true according to our analysis. We have this proprietary Morgan Stanley Free China Liquidity Indicator published every month, but up until June, that indicator has always been negative, showing that not enough liquidity to come into the financial market to support asset pricing.
Right.
It turned positive for the first time in 2 years in June, and then sustained at that level in July. And why is that? Because the front loading of the local government bond issuance earlier this year had finally trickled down into the corporate sector. So promoting the corporate sector to be more willing to borrow borrow and potentially invest and then expand their business. So those two things, I think, make us believe that this time the cycle can be really different from the previous cycles.
And, just to back up to June, because you guys said back in June, buy the Asia market. Was that the trigger specifically when that specific metric went positive?
Yes, absolutely. June was the first time the free liquidity turned positive.
Right. So what are the risks to watching? Apart from that, obviously, as a leading indicator?
Yeah, I mentioned onshore bond yield, so that's extremely important to monitor to see how the onshore investor sentiment could switch back to relatively more conservative. And then, of course, I think fundamentals will need to catch up, right? We cannot just sustain a market rally purely just because sentiment is going up.
Right.
So fundamentals, we need to go back to corporate earnings. The first quarter of this year, I think when I was here last time, I told you we had a very first inline result quarter for Asia market over the last 4 years' time.
I remember that,
Yes. So now we are still collecting all the data for the second quarter results season. I'm expecting another inline result, so that would be extremely important for the sustainability of the rally if it happens. And then policy events. We have the fourth plenary coming up in October. So I think, anti-involution and social benefit reforms, those actually will reinforce the conviction that the government policy is prioritizing more towards consumption and trying to rebalance the economy. So that would be a very important signal to watch. And last but not least, I think people look at margin financing and think about the fact that current margin financing level over 2 trillion RMB, once again beating the 2015 level. So people think that could be an alarming sign. We monitor that very closely.
Is it or is it not?
Well, it is an important metric to monitor, but we look at the ratio rather than the absolute amount.
Okay.
We look at margin financing as a percentage of total free flow market cap, and also margin financing as a percentage of the daily trading turnover. So both are still very stable and below the 2020 level or the 2015 level. So I think immediate government intervention at this point is unlikely, but we should just monitor all these factors very closely.
Just to clarify, intervention to prevent any bubbles, just to
actually cool down potential bubbles.
Okay.
Yes, and because margin financing is a measure that you look at how much leverage is being taken to invest in the stock market, which government would care and worry about people becoming too speculative and potentially triggering a systematic risk.
Okay, so don't get too excited over the absolute level. Look at the ratio. Okay, the other thing I want to ask you is what now happens to the Hong Kong market, right? So we've seen southbound flows, I believe now, it makes up a substantial portion of volume. Right, so that's a big thing for Hong Kong.
Yes.
What happens now if the other side of the pond is doing
well? I think after summer, the dynamics for the Hong Kong market can start to improve again. And this was another reason why we switched the preference from Hong Kong back to Asia's in June. We were seeing all these catalysts starting to support Asia market, and at the same time, we saw a lot of uncertainties being built towards the Hong Kong market, right? So southbound has always been there as a very supporting liquidity source, and year to date, it has already surpassed $120 billion. As cumulative total inflow, and we think it's going to stay positive for the rest of the year. And southbound flow actually now represents up to 40% of the daily turnover of Hong Kong in terms of daily net inflow, and the total southbound ownership of Hong Kong market is around 15% of the free flow market cap. So I think the importance of southbound in the Hong Kong market will only become more and more important from here. And Beijing is very much supporting of Hong Kong's global financial hub status, and this serves not in the best interest in Hong Kong, not only in Hong Kong's best interest, but also in Beijing's best interest as well.
Okay, so we've established that the view that the market should do well over the next at least few weeks or so. So which sectors, which factors do you think will drive alpha here?
We actually still like the technology sector. We think this is a long-term theme that we should hold on to. There could be some near-term volatility associated either the Apple supply chain or the Nvidia supply chain, but I think the long-term localization theme is here to stay. So we have always recommended investors to hold on to large cap names that have transformed themselves into AI leaders such as Tencent and Alibaba. And we have some other niche players on the edge AI side, which we think China actually has the leading position on a global basis with the data availability and with the deep penetration of mobile technology. And aside from that, we actually still think that investors can hold on to some dividend yield plays to smooth out the volatility volatility. And recently we had some exposure to insurance within the financial sector. We think that's a good place to be.
Why did you add to insurers? What was the thesis there?
Yes, because if you think about it, particularly the domestic insurance players, right? The interest rate environment in the onshore, and we just talked about it, is actually stabilizing and potentially picking up. So just from a revenue and margin perspective, that's actually more supportive for insurers versus for banks. And the dividend yield is still around 4%. And I think compared to the rate cut environment in general on the global basis, this is still very attractive.
Are you seeing any strong evidence of flows from fixed income, fixed deposits, to the point you're making on rising yields is a good for the equity market, into the equity market?
I think that's a big important source for the rally so far in terms of incremental liquidity. Where is the actual money coming from, right? So I think, rotation from bonds into equities and from term deposits that made a few years back at a relatively higher interest rate, those term deposits are maturing as we speak, and the current rate environment actually makes equity market a lot more attractive versus a few years ago, right? And then, of course, there will be incremental insurance money coming in to buy the equities as well, given that there has been top-down guidance from the regulators, from the governments to encourage insurance companies to allocate more money into equity asset class.
Before you go, I want to ask you about your separate note here, southbound inclusion. We've established the importance of these flows, right? And you guys launched very recently here the Morgan Stanley Southbound Eligibility Trading Strategy. Not easy to say, I have to say, but yeah, so lay out, this is a back-tested strategy. Tell us how this works and what's the hit rate?
So there are two regular inclusion cycles for southbound trading. So those are the Hong Kong stocks based on Hong Kong Exchange assessment that they become eligible for southbound trading. And every year in March and in September, there will be two batches of separate stocks being included into the southbound channel. So our backtest shows that actually these groups of stocks on average would actually deliver very decent absolute return up to 30 days prior to the inclusion date. And they also, as a group, outperform the Hang Seng Index. So this would be a very effective tactical short-term trading strategy that can help investors generate good alpha. So what we do is, the key question is, do you know who will be included in the next cycle?
Yeah,
so I think
that's a key question.
Exactly. This is the tricky part. So we developed this model based on our own understanding of the eligibility test, and also with our own further refinement based on quality factors. And we forecast there's going to be 19 stocks that we think are highly likely to be included in the next cycle, which is September the 8th. So now is the time to actually get some exposure to these stocks and hold up until the inclusion date.
Which is the 8th, I believe.
8th of September.
Okay, so that's quite short.
It's coming up. So this is very timely.
It is. And I think, we're about 10 or so days away. It's almost like buy under, not buy on a rumor, but, buy under speculation and then sell on the actual fact. Anything else we've missed? Any risks to watch, internal or external, to this equity market?
Well, I think from here, quarter results, as I mentioned, that's extremely important. And just monitor the onshore margin financing balance, but more importantly, the ratio. And we will highlight to investors if we start to see any risk building up or any inflection points coming. And I think external factors, the Fed rate cut cycle, that's a heated debate in the market. Of course, that will also impact global risk sentiment and potentially the allocation back into China, particularly into Hong Kong. So we feel that, as we get closer to the rate cut cycle, the allocation back into China will also start to pick up, given that China's macro actually is indeed stabilizing, and the earnings revision downward cycle is actually wrapping up. And the current positioning by global investors is still extremely low, even though the sentiment towards China has already warmed up. Yeah. So I think the gap there to actually close is very promising in China's case.
Laura, thank you so much. That was great. I was trying to avoid talking about the Fed there, but all roads lead back to Jay Powell somehow. Laura Wang, thank you so much. Have a good weekend ahead. Out of Morgan Stanley, their Chief China Equity Strategist. Right, going into the first, what time is it now? 14 minutes into the session here right now. I'm looking at my screens. And we'll take a very, very short break. We're looking at gains. Last we checked, Hang Seng Index, 0.5%, 25.24.5. Nikkei's also up. Inflation coming through this morning out of Japan. More on that as well in a moment. Happy Friday. This is the China Show. Welcome back. You're watching The China Show. Smartphone giant Xiaomi, well, it's not EVs as well here, has succeeded where Apple failed by launching, to the point we just made there, its own electric car. Now, the dramatic pivot has helped the Chinese company gain some $120 billion in market value over the past year or so. Our team at Bloomberg Originals has been looking at the company's push into the EV sector. Here's a preview.
What tech giant has a connected ecosystem of products, a devoted fan base, and is constantly innovating? If you're in the US, you may say Apple, but in China, it's Xiaomi.
It's this consistent marketing to the younger consumers in China that has cultivated kind of a cult following.
For many consumers in China, Xiaomi is Apple, is Tesla, is Google.
Now, Xiaomi has managed what Apple failed to do: build a car.
Xiaomi shares have touched a record high after strong initial orders for its new $35,000 SUV.
So within 3 years, they managed to set up this very complicated supply chain in China and essentially churn out these incredibly popular cars.
Profits have jumped as customers rush to the company's latest offerings. But succeeding in the world's most crowded EV market isn't easy.
Competition is really fierce right now.
Growth will mean turning Xiaomi into a global brand. And this is no easy task when the world's biggest economy is effectively off limits because of trade barriers. Yet, Chinese companies are already tapping markets beyond the US. So, is Xiaomi on easy street, or will it be a bumpy road to success?
And our subscribers, of course, can watch the documentary in full. Right now, it's on the Bloomberg terminal. It's also on Bloomberg.com if you happen to be on the internet. Right, it'll be also up on the Bloomberg Originals YouTube channel later on. Let's stay in the tech theme, but to a Bloomberg scoop now. So you have Meta hiring Apple AI executive Frank Chu to join its super intelligence lab. So he's the latest Apple engineer that Meta has poached, even as they, of course, slow their recruitment overall. Mark Gurman, who broke the story and joins us from LA right now. Mark, fantastic piece yet again. How does this then sort of change the AI strategy of Meta here? And what do we know exactly about this new addition?
Apple has been bleeding talent to Meta. They've lost now upwards of 6 senior AI model-related engineers and executives over the last 2 months to the social network. For Meta, it's very clear because of this hire that they're working on AI infrastructure, which means they're wanting to optimize cloud compute. We reported as well, Meta and Google Cloud signed a $10 billion deal. So what you're probably going to see here with this Frank Chu hire is more optimization for how to use that cloud infrastructure and maybe the development of Meta's own cloud infrastructure. You're seeing someone here who has a lot of experience training in-house models, and he would go along nicely with all the large language models engineers that the social network has hired in recent months as well.
Yeah, and so Mark, but they've also been slowing AI hiring. How does it dovetail into that sort of separate conversation, or are we reading too much into that?
Well, they've paused hiring for superintelligence labs. That's sort of their core intelligence group, the one that you see them offering multi-million-dollar pay packages to join. Yeah. But they're making business-critical hires, right? So they haven't stopped hiring. They haven't stopped investing. So this is a business-critical hire in their view, and I would expect several more, actually.
Okay, well, Mark, looks like you have lots of busy weeks ahead. Fantastic. We'll wait for an update. Mark Gurman, fantastic as always. Mark Gurman there, our managing editor covering Apple and consumer tech, joining us out of LA. We'll take a short break. 21 minutes into the session here. Shanghai Comp, we're still waiting to hit that 3,800 level. We did get extremely close to it, and we're about 18 points short. We're still up 1/3 going into the Friday session. Plenty more ahead. Welcome back. Check for markets. A check of markets right now. Individual stocks we're tracking. Again, we're in the thick of earnings season. We got a beat out of leaning, and as you can see, 8.5% to the upside in the first 20 minutes of trades. Haven't looked at volume yet, but I would imagine, of course, volume is spiking, of course, on the back of these sort of regular cadence events. That's a reference to earnings, of course, just trying to sound fancy. Minisol. Okay, this stock is up the most since December of last year. I think we had an 18% pop back in December. We're now looking at the high since about Feb. That's also an earnings story, and you have Jefferies and Goldman lifting their respective price targets for the stock itself. So we'll see what happens with this over the next few days or so. Hua Hong Semi, this is a chips conversation taking place, and as you can see, this overall tide is rising as Nvidia, again, the latest of really what's been a consistent theme of maybe H20 not being so much a challenge in China, but an opportunity, of course, to fill that gap. And SMIC is up about 4%. Capricorn Tech, which is, by the way, a stock that's been on fire this year in the onshore markets. And just to wrap things up here before we move on is a look at earnings coming through later today with the likes of Wang and some of the other names you see on your screens as well. Right, now coming up, we'll be taking a stock of eco, rates, and everything in between with Wei Yao out of SocGen. Chief China economist joining us soon on that. Plus, we'll get you an update on the Nvidia story. We'll see what happens in Japan with yields moving up there. So, yeah, plenty more to discuss. We'll have a lot more on the way in the second hour of The China Show.
Welcome back. You're watching The China Show this morning. Taking a look at the CSI 300 half an hour into the session. Look, we have started to just continue to build into the session so far. We're only 0.5% higher, but there's clearly a theme that's playing out this morning. You've seen that really reflected so far in the chip stocks, for instance, that are always the big beneficiary. You have any bad news about Nvidia? It's a positive for those mainland plays.
Yeah, we're seeing that really play out across those names, specifically with SMIC. And of course, I know you caught the story early on. We'll talk more about that with Steve. That's point, and it's a major market theme. Number one, the other thing we're tracking, obviously, is the broader rally in the Asia market. This liquidity-driven rally, which Morgan Stanley, who joined us earlier on in the show, says can continue through the summer. And they're suggesting, in terms of any specific leading indicator to watch, they say watch margin debt as a ratio, as a percentage of total turnover and market cap. So it's still at stable levels. Once it gets a little bit too high, then you maybe have this risk of authorities coming in and maybe taming the speculative rush into the markets. And of course, there's also the Fed conversation going into Jackson Hole, where you have strong data on U.S. manufacturing helping trim those bets to about 70-75% probability of a rate cut in September. And to the point that some of the Fed speakers are making overnight. Fed Goolsbee said that September is a live meeting. Beth Hammack, I believe, said that she wouldn't be in favor of a rate cut if the rates setting meeting happened tomorrow, which I guess still underscores the divide right now, given where you are with inflation remaining on the hotter side of things, but again, a cooling labor market. And then you have manufacturing, which we got a reminder overnight did quite well. But yeah, the Nvidia story is something to certainly talk about, and I believe this is going to dominate markets these next few hours.
Yeah, it's a really significant one. I mean, H20 is the chip that they designed specifically for the mainland market. And what's really interesting as well, and I think Steve's going to get into it, so I don't want to take too much away from him, but just is around how this is something that was first really being restricted on the US side. It seems like maybe that's more from the China side. But let's just bring in Steve now, our Chief North Asia correspondent, with us here this morning. So, Steve, talk us through. I mean, what are the sort of big takeaways right now?
Well, the biggest takeaway right now is we were getting some headlines out of Taipei where Jensen Huang, the CEO, is speaking, and I was like, please, reporters, ask him about this, right? So
do your job.
Do your job. But there's been no headline about whether that story from the information that there's been basically an order to part suppliers to the H20 chip to stop supplying, basically a production halt. TSMC already had been, had resumed production of that, because if you take us back a month is when Jensen Huang had gone to the White House, got the White House to approve essentially a resumption of the H20 chips to China, the AI, some would call it a more watered down version of the most advanced AI accelerators from Nvidia to China. And then there was a flood of orders from Chinese companies. But what we've seen since since then, obviously, from the reports from the Cyberspace Administration of China, the CAC, the NDRC, the National Development and Reform Commission, also the Ministry of Industry and Information Technology, MIIT, essentially encouraging, if not ordering, Chinese domestic companies to not buy the H20. So a complete back and forth, whipsawing back and forth in sentiment towards the H20, which, of course, was initially banned by the Trump administration, as you mentioned, Belle, back in April. So there's been a lot of back and forth on this. Now we need to see whether Jensen Huang actually can confirm that, inventories are piling up at Samsung. They provide the high bandwidth memory components to these AI chips. Also Amkor technology, which does the advanced packaging. The reports from the information is the inventories have been piling up because China has stopped ordering. And now the report is that Nvidia has told them to essentially stop. So again, Jensen Huang right now is saying he's going to TSMC to go talk to them about the Rubin architecture, which is the next generation beyond Blackwell. It went Hopper, Blackwell, and now it's going to be Rubin. But again, I'm sure he's going to be talking to him as well about the production lines for the H20, which looks, according to the reports right now, is going to be suspended or slowed down because of slowing Chinese orders for that. They have security issues. They're obviously worried about backdoor issues for that chip. Keep in mind, the Trump administration secured 15% revenue commission, payments on all those H20 chips. So the Chinese government is not only insulted by some of the comments from Howard Lutnick, who says we're not selling them our best chips, we're not selling them even our second best or our third best. And the reports are the Chinese ministries that I mentioned are upset about that, but they're also concerned about possible backdoors in the H20, that sensitive Chinese data could go to the United States. Jensen Huang did address that today, saying there are no backdoors. There is no national security threat with the H20 going to China.
If he doesn't comment on this today or the next few days, this is probably going to come up, if not likely will come up at the earnings call, which is in about a week's time.
Yeah, I would bet somebody is going to ask them on the earnings call next week. August 28th, Thursday next week, Friday our time, we're going to get quarterly earnings from Nvidia. And it's interesting, too, how this will play into the calculation of forward earnings and forward guidance. Already price targets have been raised by some 9 very influential analysts. But again, one of them put out a report on August 18th. C.J. Muse of Cantor Fitzgerald said China is already de-risked in street modeling, and the goal here is to get China to build on Nvidia's platform. Well, wow, a lot has changed in just a few days since that report came out. So how much does this change that street modeling for sales? Because Jensen Huang has talked at length about how important the Chinese market is and how much revenue takes a hit for not having the H20. And also, we're going to, the analysts need to ask him as well about the next generation of chips based on the Blackwell Pro 6000 architecture that was supposedly to go to China as well.
Steve, thank you so much. Stephen Engel there, our Chief North Asia Correspondent. Let's get the context and markets with Mark Cranfield with us right now out of Singapore. Mark, it's not as if tech was doing well going into today. I mean, some softness going into Jackson Hole. I think S&P was down 5 straight days going into this morning. But this is yet another reason, perhaps, to look at this cohort that's coming under pressure. How do you see this?
Yeah, I mean, as you've just been discussing there with Stephen, I mean, you think the risk is next week when Nvidia has their earnings. Well, it's already happening right now. If investors don't get clarification in the next few hours about what's happening with these chips, then you're probably going to see a fair amount of weakness in the European markets when they start happening later today. As Belle was saying, what's bad for Nvidia is good for the local Chinese tech companies. So we're seeing some improvement in the big names there early this morning. Well, that's going to be, on the flip side, that's negative. You're going to probably see NASDAQ futures trade a bit more poorly, particularly once Europe gets going. They tend to be the ones that push this around in advance of the US markets. So what probably people are thinking is going to be a relatively quiet day ahead of Jackson Hole. It may well be a busy day in the tech market because people will be already concerned that Nvidia's got these big results coming out next week. Now there's clouds over this H20 chip. and the whole thing will be brought forward. So people who are looking to be defensive may well decide, well, I'll do that right now. I won't wait until next week. I'll just get out of the way. Plus, next week is a poor liquidity week. It's the week leading into Labor Day holidays. Notoriously, one of the worst weeks for market liquidity in the US in terms of Wall Street, because it's the last holiday week in the school season. So all in all, if you're a person who's a little bit nervous here ahead of Jackson Hole, today's your day for getting out of risk, and it may well be the tech sector that takes it on the chin.
Yeah, and on that point, I mean, you mentioned Jackson Hole, of course. Jay Powell's speech coming up later today is going to be extremely closely tracked. But we heard overnight, it seems like the Fed is really having a lot of difficulty here figuring out whether they need to cut or not.
Yeah, I mean, if you're an investor and you've been watching the news wires for the last few hours, you've had at least 4 Fed speakers already. You've got Jerome Powell coming up later today at Jackson Hole itself. There'll probably be a few other Fed speakers as well, because the whole team is there, all wanting to be interviewed. And they're flipping back and forth between different kinds of views. Some are on the fence, some are not. It looks as though it's going to be a really split decision. However, there is one more jobs report to come before the Fed sit down. If that unemployment rate ticks up to 4.3, you can bet the market will go full-blown for a 25 basis point cut in September. They may even push beyond. They may start looking for a 50 basis point cut. It really all comes down to where that unemployment rate is. It ticks up to 4.2. We saw the market carnage last year when it dropped to when it rose to 4.3. If we see another 4.3 on the unemployment rate, it will be odds on, as far as the market is concerned, that September is going to be at least a 25 cut, maybe even more.
That was our Bloomberg MLive strategist there, Mark Cranfield, joining us this morning, and just some updates as well that are coming through this morning, because we have the Shanghai Cooperation organization, that summit is going to be held from August 31 to September 1, and we're getting some alerts this morning from China saying that Narendra Modi, also President Putin, and also the Belarusian president as well, Alexander Lukashenko, will be attending that event. China's also saying that she will announce new measures to support that organization's development. But we'll get more details on that ahead, Dave.
Yep, absolutely. In fact, we'll talk more about that, a preview of the weekend coming through, plus, of course, China's president telling his government to pay its bills on time or risk a public backlash. More on this warning over debt delays just ahead here in shows, plus plenty more. We'll look at macro next with SocGen as well. This is The China Show. Happy Friday.
I don't see any chance that there's a nod toward a September cut or any promise of a September cut.
The caution I would give, if they do move in September, I don't think that's the start of a cycle. I think it's an individual decision. Then they'll wipe the slate clean and take the next 6 weeks, try to understand these cross currents again.
I think they're modestly restrictive. I'm still trying to find ways of what's being inhibited in the economy from where our policy rate is today. But I think we're on a good path.
For sure, it feels to me like it's a live meeting. As you know, before April 2nd, before we got some uncertainties coming on the policy side, I believed that we had pretty stable full employment, that inflation's coming down to target.
There we go. If only they had one consistent line there, we wouldn't have anything to talk about. Certainly giving us more responsibility here as responsible financial journalists to really discuss and dissect where the Fed's going to go in that live meeting coming through in about September 18th. It's about 20 or so days from now. Well, let's get a sense right now of what the markets and economists think of the Fed's path. Joining us here is Wei Yao, Head of Research, Chief Economist, APAC at SocGen. Good morning. Nice to see you.
Yeah, good morning. Good to be here.
September's live for the Fed. Do you think they're going to cut?
Well, it is live. We agree. But, as the Fed keeps saying, everyone is like they're watching the data, right? So they're watching inflation. We still have some very important data we haven't seen, the employment, the inflation. They will definitely be very critical for this decision. The Jackson Hole, I think it's probably not wrong for the market to be a bit more cautious now, to scale back some expectation, because yeah, still the decision is not final. And it's also probably not going to be the case. Powell will commit to one way or another, right? Why remove your own option before the evidence, important ones?
It is sort of shaping up, though, that you're sort of seeing it, inflation or signs of inflation accelerating. The labour market looks to be decelerating. It's a dual mandate. So which one do you think they're going to be more concerned by?
Well, I guess there is a lot of concern. Partly is about history. Right? We had a history in the 70s, 80s. In the end, if inflation is out of control, you just have to tighten policy, even though the economy is weak. Of course, we're not really there stagnation, but this risk is not removed. So I think the whole experience with the tariff is a very humbling experience for all the economists and everyone. Is like we're basically running an experiment to see that, okay, what exactly is going to be the tariff impact on economy and inflation. There are a lot of things that prediction that has not panned out, in terms of how inflation can be. It may still indeed be delayed, but then the argument would be, does it make sense to act based on the evidence now, then be nimble and ready to change mind later, right? So that might be the question here.
Yeah, to your point, it's almost behavior, right? You don't know when companies specifically are going to pass that on, and then you just have to act if and when that happens. Where we do have some evidence, I wonder if you could share insights, is into trade data coming through across the region, exports numbers. The recent months, what is that entire data set telling you now about where exports will be in the months ahead?
Yeah, indeed. It actually has been very fascinating to watch all these data to an economist, I have to say. So we've done some research recently. We're looking at, the front-loading question. It's very interesting that basically there are only three things being front-loaded. Gold. It happened for 2 months, that's gone. Pharmaceutical and electronics. All right. For pharmaceutical electronics, we're still waiting for the 232 investigation results. So when that hits, this probably is going to end. And electronics is the one matter for the entire Asia region. And by estimate, this part of front loading, we think it's about 10 to 15% of the entire export of Asia in the first half, maybe until July. So this will go away. But then you look at Taiwan data in July, it was still very strong, not just their direct trade to the U.S., but also to the region. So is China, right? China, the direct trade to the U.S. actually pretty weak. It crashed and very little recovery. It's probably the index supply chain demand on the electronics that's supporting China and some of the Taiwan strengths, which means this trade may still have like 1 or 2 months left to go. Right.
Yeah, exports, at least from China, seem to your point, have kind of remained resilient for now. But what do you think happens about the China Plus One model, and how does that sort of shape up as well?
That is a very big question now. And actually, we start to wonder, maybe the new tariff regime from Trump may not really put China in much more disadvantage here. Because it was only China. Everybody knows China is the target. Now everybody gets tariff, right? And the tariff on China Plus One seems like minimum 20%. So that significantly closed the price gap, sort of, with China. It was 140 and 10. Now it's 30 and 20. So that gap is smaller. Then you look at how Trump had been waging this tariff war, is that any moment, for any reason, not exactly related to economics, he can impose tariff on some country, right? So we add this volatility factor into the tariff regime. Then for companies, like, why do I even need to bother and move things around again, right? So that is becoming a very important question. If this thing is not going to settle, I wonder maybe something just going to stay in China. It may not really make China worse here.
Yeah, and in 3 years, right, to your point, he's not going to be there anymore, right? So we don't know what that's going to look like. And, I kind of feel bad for economists, right? Because you guys get these questions, these non-economic related questions, right? I was looking at the calendar. It's actually now 11 months since the big bazooka briefing out of the PBOC in September of last year. Where do you think the economy is now?
So the economy had some good momentum at the beginning of the year, right? Then the tariff war hit. It's interesting that, the consequence from this tariff war so far is very surprising. It's not bad for the exports. Actually, exports have been good for the reason we just discussed. But it's actually the domestic sentiment housing weakened again, right? So you look at the housing sector, it's definitely worse than where it was. Every month seems to be still getting a bit worse. worse. And then the July data was just very clear that, the investment demand weakened across the board, credit demand across the board, consumption really only supported by subsidy, not much else. So we're basically, again, back to where we are, is the domestic economy needs a lot of help. The policymakers, they do have the intention to, but it seems that they're still kind of maybe waiting for timing or maybe need more pressure to act more decisively. That seems to be where we are, it seems.
I mean, we had sort of those expectations and they failed to appear for big bang stimulus. What has sort of been the bigger policy shift we've seen of late is that anti-inflation campaign. But is that really going to have any impact, you think, on ending that sort of deflationary, that broader deflationary mindset?
Yeah. First, what I read from that is it's a good signal. It's a good signal showing that the Chinese policymakers understand deflation is bad. It's bad for many, many reasons, right? So it's bad because it hurts the fiscal resource. You have deflation, how can you build your fiscal resource and support the economy on a sustainable basis? And it's bad because it also hurts China's kind of vision to dominate supply chain because companies, they don't make money, so how can they last or innovate? So that speaks to the sense of urgency which is needed. Then the question is the method, right? Telling companies not to lower prices, we all know it's not going to work. It's a temporary measure at best. Maybe it is indeed just a temporary tactics. The more sustainable solution will be supply-side consolidation, especially for some for some sectors. The whole solar supply chain, the EVs. These sectors, no matter how you boost demand, it doesn't address the issue because there's too much supply.
But those are not government-controlled, though, unless in 2015 it was steel capacity, SOEs, but these are private enterprises. So how do you accelerate consolidation?
But how can China end up with so much capacity dominating world, right? We all talk about there's industry policy at play, right? So you have to be consistent. If it's true, they're private companies, but they've got a lot of help from local government, central government, everybody. Now, it's a question that, for example, when we think about this consolidation question, there are two ways to do it. You can do it like, right now we have this, interestingly, the solar kind of upstream supply, cartel forming up. But you can also just let the market mechanism play out. The weakers go out, right? But you need to kind of balance the economic pressure with the pace of the supply consolidation here. Yeah.
Yeah, certainly some mixed messages there. That's Wei Yao, their head of research and chief economist for APAC at Societe Generale. Thanks so much for joining us and enjoy your weekend as well. We said no typhoon. Hopefully we can spend some time outside. We'll have plenty more ahead. This is Bloomberg. Well, in some world news this morning, a New York appeals court has struck down a $464 million penalty against President Trump and his company. The panel upheld findings that Trump inflated asset values but called the fine excessive. Attorney General Letitia James says her office will challenge the ruling. The decision eases Trump's legal troubles, adding to other cases dropped since his re-election. And President Trump has hinted that he's open to Ukraine launching more attacks on Russia. That's as the White House seeks to pressure President Putin into a meeting with Ukraine's leader. In a Truth Social post, Trump wrote that it's hard to win a war without attacking the invader's country. He later told Newsmax we'll know in about 2 weeks whether peace can be achieved. The Kremlin so far remained non-committal on any summit with Ukraine's president. Secretary of State Marco Rubio says the US will immediately pause issuing worker visas for commercial truck drivers. In a post on X, he says the increasing number of foreign drivers operating large tractor-trailer trucks on US roads is endangering American lives and undercutting the livelihoods of American truckers.
All right, let's have a look at these markets. About an hour into the session here, Shanghai Comp, we've been waiting for 38. And as you can see, we've been bobbing and weaving just below that specific level. Keep an eye on turnover again today. We've been north of $2 trillion a day for about 7 days now. So we're about an hour into the session. I'll get you an update on turnover in a moment. Earnings, we can set that theme aside, but I can tell you there's a lot of big earnings coming through and reaction leaning, Miniso. But the other big theme across these markets is the reaction in the chip space, positive one, quite clearly and consistently, as you can see on your screens, in the A&H share market. That's on this Nvidia story of it's looking to halt or slow production of its H20 chips. It's told some of its suppliers, according to the information. Right, so on the other side of this break, and we'll take a short one, we'll have a look at Japan. The inflation numbers coming through there, the prospects for a rate hike coming through. Not a full one is priced, in fact, this year. You get a full pricing by January out of the BOJ. Inflation, though, fell, but came in above expectations on core CPI, so we'll unpack that. And, of course, this melts up in yields that we've seen in the JGB market. That's all ahead. This is Bloomberg.
11:29 a.m. this morning in Tokyo. Japanese markets are just about to go into their break. You've got the Nikkei 225 sitting flat this morning, but I don't really think that's much of a surprise when you've got Jackson Hole. You've got liquidity thin trading next week with a lot of holidays as well. So ahead of that, we're really just, of course, assessing, is the Fed really ready to hike? September, very much a live meeting. And you can add to that as well. We had the inflation figures out in Japan this morning as well, and we saw still some pretty sticky price pressures. So we're watching JGBs and the yen, of course.
Yeah, I mean, the risk for markets, to the point you were making there, right? So we're hoping that Jay Powell gives clarity, but how much clarity can he actually give? I mean, we could find ourselves in the same boat this time next week, right? Because there's certainly no upside to committing 100%. It's a delicate balancing act. How does he strike not so much a complete commitment to a cut, but also not walk back what the market's been pricing as well? And maybe the nuance is going to be the important thing there. If you're still up at 10 p.m. tonight, certainly we're not going to be. Send us a note. Yeah, let
10 p.m. My gosh, you must go to bed early.
I am in bed by 8:30 at night. My eye bags probably don't tell you that, but I can tell you I am a very boring person recently.
All right, early bird.
Well, recently, the last 5 years or so. It's actually nice to get in bed at a decent hour.
It is. You do feel very rested the next day. Anyway, let's move on. So the big story this morning in the tech space, and I think you can see that reflected there, that IT is a little bit high here. Yeah. That's probably going to be a lot of those Chinese chip names that really benefit when stories like this cross the terminal. But this is reporting from the information. Essentially, Nvidia has asked suppliers to halt work on H20 chips. Let's get more on this now, bringing our Bloomberg Intelligence senior tech analyst, Robert Lee. So, Robert, just some context here. I mean, we know that H20, this is the chip that was designed for the Chinese market. Trump banned sales of it to China. He reversed that. Now it seems like China is actually asking companies to not buy the chips as well.
Yes, that's right. It's the ongoing saga of the H20. But sort of taking a step back from the news and the headlines, the direction of travel, I think, has been very clear. And that is one of China's main strategic aims is to pursue self-sufficiency in the technology sector for all sorts of reasons. I mean, one of them being in the US is obviously a major geopolitical rival, and also from a Chinese perspective has been proven to be an unreliable partner. So I think that's one reason. And then the second reason being that China is looking to the high-tech sector as a driver of future economic growth to, with new productive forces, shift away from maybe the previous reliance on investment spend, looking to high tech as a driver of future GDP growth. So that's the sort of backdrop to all of this. And then we've seen these, as I say, ongoing saga, which I think is the best way to describe it. You know, is H20 on? Is it off? I think it was a week ago. There were some stories coming from China or unconfirmed reports that the government was encouraging local AI companies to use the locally derived Huawei product. And now we've seen this story that is reported in The Information, which seems to be confirming that, and then Nvidia allegedly taking action in response to that. So I think in the long run, China is going to continue to drive self-sufficiency aims within tech. They can continue to encourage their AI companies to use locally derived chips. And I think, what does that mean for the likes of Alibaba and Tencent? Obviously, there have been some bottleneck and disruption on the chip side, but on balance, given their existing inventory of supply, given the rising supply from local suppliers like Huawei, then net-net, they should be on track to continue their AI developments.
Well, speaking of AI, the way our headline is written, Kuaishou, is Kuaishou's revenue beat underscores its AI potential.
Yes, which is uncharacteristically positive, written by me.
Yes.
I think that was.
I was hoping you'd pick up on that. Thank you for doing so.
I would say, I like to approach things in my view, rational point of view. I think the monetization remains a major challenge for the AI software companies. But I think what we saw from Kuaishou last night, which has developed a text-to-video engine called Kling, we're actually seeing, it's early days still, but we're seeing a reasonable level of monetization coming through. I think for the quarter they just reported, they generated 250 million renminbi in sales. Last quarter it was 150. So it's all moving in the right direction, but I would say it remains a low level. So that's quite encouraging, and I think the conclusion of all of that is if people are going to make money in crude terms in AI, obviously it's clearly on the Nvidia side, the infrastructure side, the companies providing the chips and the cloud computing services that their clients need to develop these models. But the real money or the greater prospect is in the AI applications rather than the large language models. Because again, in a China context, there are more than 500 large language models in the country at the moment. The sector is completely commoditized. It makes it very, very difficult for anybody to make money developing large language models. But using those models to develop new software, at least, we're seeing potential light at the end of the tunnel that, value-added AI applications that consumers or businesses recognize the value in can generate real revenue. So I think that's early days, but an encouraging sign.
Bilibili. We haven't talked about Bilibili.
Bilibili, I think, again, it's coincidental we're talking about two of the most interesting sort of mid-cap names in the China internet space. Bilibili is really well positioned with the Gen Z cohort. They're a go-to platform for that. Previously, they've been referred to as the YouTube of China, just to give people some background if they're not familiar with the company. But their advertising is growing at 20% plus, which in this environment is really decent stuff. The issue, though, for Bilibili is that they have had an inconsistent track record on video games. They have one main title at the moment called Sanmo. It's done quite well in China. They were looking to expand that internationally, and it appears that that's been delayed. I think that's why you're seeing some profit taking on the stock today. But I think, it's a very interesting name, given advertisers will spend their dollars where consumer eyeballs are. That's short videos, that's Gen Z, who have a greater propensity to spend. So the likes of Kuaishou should continue to do well in ads, and Tencent. In contrast to Baidu, which we saw earlier this week. Not picking on Baidu, but their ads were down 15% year over year. And then poor old Weibo as well, 1 or 2% annual growth. These are legacy platforms. So again, advertisers are only going to spend where they see the scope to generate return. And Kuaishou is very well positioned, as is Bilibili.
It's quite remarkable, really, when you sort of compare on that ad revenue metric. But you do seem positive on both companies. So do you have a preference between them?
I think on balance, Kuaishou is probably the more interesting of the two, again with this emerging strength on the AI side. Just again to give a balanced view, obviously AI is a very expensive business. There's a heavy level of development spend. Their margins did come below expectations in Q1. But again, I think the strong rebound we saw in Q2 gives confidence that things are getting back on track. And also the other thing that Kuaishou's got going for them is they have emerging strength in the live streaming e-commerce sector. So this is essentially they're a live streaming platform. They are a host to various so-called KOLs or key opinion leaders. These are the influencers in an Asian context. These are people who are live streaming, pushing various products, and Kuaishou, in crude terms, gets a cut of that revenue. So the live streaming e-commerce business has done very well. So they've got two potential drivers there. As I said, in contrast, Bilibili's ads is doing really well. Live streaming, their main video platform's doing well, but they're a bit inconsistent on the game side. So relatively, I think there's less risk with Kuaishou and two distinct drivers of their earnings going forward. So on balance, I think that's the more interesting name.
And is there a consistent takeaway then as far as what this means for the sector as a whole?
Yes, I still think on the AI side, monetization remains a major challenge for most companies. Again, if you're developing large language models, as I said, it's commoditized in China, very, very difficult to monetize, but the money is clearly on the infrastructure side. So obviously Huawei's a private company, it's not an investable opportunity, but obviously they would be benefiting from that. I think forwarding to next week, we'll see Alibaba report on Friday. Obviously, there's been a lot of very high expectations with them on their cloud side. We'll wait to see what they say. But I think the real risk on Alibaba is, while seeing revenue growth on cloud that is AI-driven, there's a huge amount of competition and margin pressure. And if you remember from last quarter, their cloud margins actually missed expectations. Plus, Alibaba has a huge amount of pressure on their e-commerce side. You saw JD.com disappoint recently. So I think, AI is clearly, the way to go.
Yeah, and fantastic. Thank you so much. Okay. Robert Lee there, our Bloomberg Intelligence senior tech analyst. And that takes us into the humanoid robot conversation, right? And I think if you think Belle and I look the same, what we're wearing today, wait until you see this cohort of friends that we have here on screens. Have a look at the future lineup of our replacements, basically.
Exactly.
This is a fantastic graphic, Belle.
Yeah, made by one of our colleagues, of course, in the production team, but we can just take a look at really some of the standouts in the space. I think if there's a name that really jumps out, it's Unitree, of course. They're really one of the big leaders, but Ubitech, that's a listed company here in Hong Kong. Agibot, Deep Robotics, really it's that big competition. Who can win in the Chinese market? It's very far from settled, but we had the tech show this morning and this episode looking at the humanoids market, why we're seeing such intense competition in China, and as well how they're looking to lead the world. But take a listen.
It's very likely that humanoid robots are going to be robots that we can deploy into the world relatively easily.
From labs in Shenzhen to workshops in Silicon Valley, humanoids are stepping out of science fiction and into our reality. The race is on to dominate the next era in robotics, with companies in Asia and the US vying to take the lead. China is seen as a frontrunner, with Morgan Stanley saying the country will have the highest number of humanoids in use worldwide by 2050.
It's the result of many years of government support, advancements in AI, and a strong manufacturing base that gives it more than a helping hand.
The market is poised for explosive growth, with the International Federation of Robotics noting two primary reasons for its rise: a chronic lack of workers combined with ageing labour forces in developed nations. Yet sales channels are fairly limited so far, with universities and research institutions currently some of the biggest buyers.
This might seem like just a gimmick, but the humanoid companies in China, like Unitree, are blending tech and entertainment as seen as a serious path toward commercialisation.
Ultimately, the goal is to bring humanoids into households, with varying estimates for how long that might take.
I think maybe 3 or 5 years, the home robots can do the common things in my home.
We are still a bit far from that, because as you can see right now, like the robots cannot perform as in the movies that we are used to see.
It may be decades before humanoids are a common sight in our homes. On the factory floor, though, it's already becoming a reality. Bloomberg Intelligence says improving battery life and efficiency gains in humanoid robots could make them virtually as cost-effective as human workers by 2035. That sort of potential is creating intense competition, particularly in China, where concerns are already growing about overcapacity.
We have a humanoid robot frenzy here. Everybody try to break into the space. I think probably a lot of these companies are not going to exist in the 5 years down the road.
The question is whether this level of interest in humanoids is unhealthy or the right way for the industry to develop.
Well, as we said, humanoids was the focus of the tech show today, and you can re-watch that and, of course, all the other episodes we've had so far. But on YouTube at Bloomberg Tech Asia, BTech is at the end of every month, and you can watch our next episode at the date on your screen. We'll have more ahead. This is Bloomberg.
Welcome back. Time for Trending in China and a look at what's making headlines in national newspapers. You have state media outlets have announced a new book of President Xi Jinping's speeches. The volume includes Xi's warning that the Chinese government's delayed payments to companies risks undermining people's trust in authorities. Let's bring in Min Lo, our China correspondent, to give us really more context about when and what, of course, the president said here.
Yeah, this actually took place back in February when President Xi met with Jack Ma and the other private entrepreneurs. There was really a turning point showing the government's support for the private sector, right? But Xinhua, the state media news agency, just published the speech in full in a book, and it showed that President Xi at the time had urged the local government to resolve the arrears to private companies because it could have an impact on people's confidence in the government. And this comes as, you know, by some estimates, David Li Taokui, for example, from Tsinghua University, was saying that the local government owed as much as 10 trillion yuan to private companies and to civil servants, and it's equivalent to about 7% of the GDP last year. So it shows you that this is an important issue that the government is paying attention to, and it comes as the Chinese government had already taken some actions, right, from that 10 trillion yuan debt swap program. And this year as well, for the first time, they started allowing the issuance of special purpose bonds to be used to pay arrears. Those were used to be, reserved only for infrastructure investments. So again, it shows the sort of urgency of this growing debt burden that local governments are facing.
And another top story in China is President Xi's visit to Tibet, which I think is the second time he's been to there as president. What does it signal to us, and what was the message as well that he had?
Yeah, so it's quite rare because he's there for the 60th anniversary of the founding of Tibet. And this is usually a very routine celebration that is attended by low-level officials. But this time, President Xi went, and it's the first time he led a central government delegation there. He didn't give a speech, but he did mention to local officials, and this was reported by state media as well, he told local officials that political stability and religious harmony are critical to the continued development of Tibet. And then there was Wang, who is the number 4 official in China, also gave a speech, and he talked about the importance of protecting that border in this fight against separatism. And it comes against this backdrop where Foreign Minister Wang Yi just completed this trip to India, right? And both India and China just agreed to continue working out, the demarcation of this disputed border that India shares with Tibet. It's always been a very sensitive area where there has been, protests in the past, self-immolation by some of these Chinese monks, and of course China and India have disagreements over who gets the right to choose and to approve the next Dalai Lama as well. In fact, Modi last month had sent a birthday wish to the Dalai Lama. He just turned 90 years old, and that was something that really upset Beijing. But it shows you that, again, the Chinese government is seeing it as a priority to further integrate the Tibetan region under the Chinese Communist Party.
Right, that's our China correspondent there, Min Lo, and we will have plenty more ahead. This is Bloomberg.
It is an important metric to monitor, but we look at the ratio rather than the absolute amount.
Okay.
We look at margin financing as a percentage of total free flow market cap, and also margin financing as a percentage of the daily trading turnover. So both are still very stable and below the 2020 level or the 2015 level. So I think immediate government intervention at this point is unlikely, but we should just monitor all these factors very closely.
And that was the Chief China Equity Strategist at Morgan Stanley, who joined us earlier and shows Laura Wang there on if you had to watch one or two things, leading indicator of the market, those were the two things she says.
All right, leading indicator sometimes maybe also is pay, or is that a leading or a late one? But anyway, we'll get to it. Chinese brokers, because they're sweetening pay packets for junior bankers in Hong Kong. CITIC Securities rivals are rolling out raises of up to 30%. That's as deal making picks up, along with competition for talent. Let's get more of our Asia Pacific deals reporter, the person as well who leads the team, but Manuel Baigori, joining us with the details. So, what's behind this?
Yes, Annabelle, that's good news, I guess. After all these years of kind of like layoffs and people not getting their full bonuses, on Wall Street. So looks like some of the Chinese banks in this wave of deal making, where we're seeing a lot of second listings in Hong Kong, are kind of trying to retain talent. And we see the likes of CITIC Securities through CLSA and also China Merchants, so the international part in Hong Kong are among those that are kind of like trying to bump salaries for some of the junior bankers. It's not across the board. We should warn. It's not like everybody's getting a pay raise these days, but I think in a selective way we are starting to see that, which is a remarkable shift from what we are coming from.
Well, are we then starting to see any signs of a talent war?
That's a great question, David. I mean, it could be the next step. You may recall, like 4 or 5 years ago, I think it was around the time of COVID, if I recall correctly, there was these talent wars. People like every bank industry was kind of raising salaries for everybody.
The great resignation time, wasn't it?
Exactly. Yeah. It was really a time in which like everybody was trying to mirror what
leverage.
Exactly. So that I don't know if we'll get to that point and when exactly. It doesn't feel that way yet, but definitely the tide is shifting and people are a little bit more upbeat. There is more to do. There is more business coming through. We'll see at the year end what it translates into the fee pool. But definitely bankers are busier. Hong Kong is back, sort of, on the back of these second listings and some IPOs, some M&A across APAC also looking better than last year. So it's better, not to the levels that we used to see before, but better.
Are the banks hiring again then, or is it more on the retention side and trying to boost pay packets? And also, you're talking about the Chinese banks. Do we see it for the US banks as well here?
Yes, Annabelle. So of the Western banks, the more consistent ones in the street hiring over the last 2-3 years, I would dare to say it's been Deutsche Bank and Jefferies. They've been really rebuilding or building out the platforms here in APAC. All the other major investment banks have been a little bit more stable, so they haven't had massive layoffs. They've been trimming some fat here and there, but it hasn't been something shocking. But at the same time, we are not seeing them building out their teams aggressively either just yet.
Manuel, thank you so much. Manuel Baigori there. You can check out their team's piece. It's on the Bloomberg terminal today. Before we head quietly into the weekend here, look at markets that have been waking up. So you have CSI 300. The Chinese index actually is the standout today, 2.4% to the upside. And we're now I'm obsessing over the Sanqianpa number, 3,800. We're now just 6 points short of that specific milestone. And the CSI 300, Shenzhen, is also doing quite well going into the weekend here.
Yeah, and the big, firstly, you've got the story that's really playing into this is the Nvidia one, because you've seen the likes of SMIC, for instance, up more than 8% right now. So, of course, this halt on H20 purchases in China benefits some of these local names. But, yeah, going into the weekend, I mean, there's quite a lot. We can start, of course, with the Fed. We got Jay Powell speaking later today.
Yeah, 10 p.m. I think Bell's going to stay up for that. I'm going to be very well in bed. HIBOR's coming on in about 20 minutes, an update there. At the close is the results of the Hang Seng Index review, and of course Ronaldo and cohort are in town in the Saudi Super Cup final here in the city, and they get to play under beautiful weather, and we'll leave you with a look at that beautiful weather going into the weekend. Happy Friday, Hong Kong. This is The China Show.